Today, we're going to look at good and bad rental markets for 2025. And most importantly, we're going to teach you to identify these for yourself.
Yeah, it's the most important thing you guys could be doing. Obviously, if you're going to be investing, you want to go where people are actually going, because that, even if you make a bad investment, that population growth can save your butt.
But I also think it's important that people know how to do this for themselves, because one of the main questions we get asked is Nashville a good market? Is like this small town in Arizona a good market? Is this a good market? Is that a good market? And the truth is, if your strategy is just to ask people and believe what they say, it's a bad strategy.
Yeah. I get this asked a lot, almost every day, I think, in some capacity. So it comes through an email, text, or I just have normal conversations with people. And as you guys know, one side of the street is very different than the other. One submarket can be very different than the other, and there's lots of things to look at. And when you're looking at these statistics, I think it's really, really important that you understand that these are national, they're statewide, they're city. That doesn't necessarily mean that even the ones we're going to talk about today are the ones you should hang your hat on. You got to go deeper. Like for example, right now we're in Phoenix. Well, there's a huge difference between East, West, North, and South Phoenix. Huge, right? And then of course those submarkets are very different. So when we're talking about these cities, we're talking about citywide, right?
Yeah, absolutely, right? So don't just think if we say Phoenix is a good spot to buy, that you should just buy anywhere in Phoenix and you're going to be fine.
Yeah, that will be a problem.
That's not how it works either. But we are going to show you how to identify, based on some cities we've pulled, and then you can do that even in a more local space.
Yeah, and we do this. This is exactly what I do, guys. If I'm going to put my money invest it somewhere, just like you guys are, whether you're raising money or putting your hard-earned money somewhere. The things we're going to talk about today are things that you can use to make sure that you're doing it better than the people that are just not doing it.
Just guessing.
Yeah.
So, Jerry, first pull up the population, because Ken touched on that already. So the markets we're going to look at today are Columbus, Tucson, Seattle, Phoenix, Vegas, Portland, and New York City. Okay. So to start, you're always going to want to look at the population of an area. And this is just basic econ. Like if a place is losing people, there's going to be more demand or less demand on rentals.
Right. And so before you go off of here, I just want to point a couple things out. Obviously, the numbers at the top of the chart, those are averages, right? And how do we know where these numbers come from? There's so much data, guys. And I think this is important. If somebody moves to another location, then of course their address changes. Okay, that's a data point as an example. And there's all kinds of ways through the U.S. Postal Service, through out-of-state driver's licenses and things like that. And these are rounded numbers, but they're very, very good numbers. That's one thing. The other thing to look at that can be most impactful would be the percentages. So when you drop 18,000 people into a city like Columbus, that's significantly more than 18,000 people, in a big city. So, you have to look at the percentage of population growth as well. So so as you're looking at both of those, you got to look at what's the current capacity. If you've got a city that has 200 or 300,000 people in it, and you've got 30,000 or 20,000 people that go there, that's a significant change in that town. But if that same amount moves to Phoenix, it doesn't even make a dent. It right. Just absorbs, if that makes sense.
Yeah, absolutely. And I do think on the Seattle, the percentage is wrong there. I believe it was supposed to be 0.26%, not 2.6%.
Right. Yeah.
So
that's kind of the point there. So if you take a look at the population growth in those two areas, Seattle's a huge city. This is where I'm from.
Right.
All right. It is big. And there's a lot going on there. Columbus is small. That's basically where Danille's from. So she's from Ohio, but she's not specifically from Columbus. But the point is, for Columbus, it's almost a 1.8% population growth based on their current size. Whereas Seattle, it was less than 3%, or less than 0.03%, right?
Right, exactly.
So it's not anyway. So that is a little bit of a mistake. But I will tell you, that's what you want to look at, not just the number of people. You want to look at the percentage impact, and then of course, like anything, where in Columbus are they moving, right?
Right.
Are they moving to the north side, to the south side, to central, downtown? All different,
The
and
suburbs.
that data is important, and that data is out there. So you can actually drill down even further, and this is how you look at submarkets. So clearly, and the reason we have Columbus on here, because we were joking around this, Columbus is one of the fastest growing cities right now.
Yep, percentage-wise.
Percentage-wise, okay? So it's notable, and you can get stuff there affordably, okay? So if you can buy stuff there affordably, and you have people moving there, could be good. Might not be, but it could be. So again, just that would be something to look for. And then when you get there, of course, you need to see where in Columbus. What is the right side of the street? Where do people want to go? So that's how you look at this data. This is very topical, and then you dig down further. But Jerry, could you pull that up real quick? One of the most notable things are the ones at the end. Portland, New York City, negative. Okay, now obviously that impacts it the other direction. So you don't want to catch a falling knife. How much longer is that going to be? Who knows?
Well, and plus, when you start to have population declines, you're going to have too much. Your supply demand is going to start to level out no matter what.
Right. And what will happen is, just think about it, guys. If that many people moved out of Portland, which is another area that I've spent a lot of time in, that means that vacancies are long. You have vacancies longer. That means that it's harder to lease stuff up. That means the retailers are having a problem. That means that restaurants are going to be going out of business because they don't have quite the amount of people. Now, of course, again, depends on where they're moving from. But all these migration patterns are super important.
Yeah, absolutely. And I know you like to look at the U-Haul data too. And I actually pulled that website. It's called the U-Haul Growth Index Report. And it's a legit thing, and it shows, if people are taking one-way U-Hauls, because the only really reason you would take a one-way U-Haul is because you're moving.
Yeah.
So, if you look at that data, that is helpful, too, on kind of what states and areas people are moving to and from.
There's another one, too, North American Van Lines. There's a couple of these out there, because U-Haul, I think, kind of started it. I could be wrong here, but they're amazing, right? Like, who doesn't want to know where people are moving? And by the way, these are one-way moves, right? Like most moves are.
Well, and everyone always thinks there's all this data, right? Where it's like, oh yeah, I looked up this report. No, we look at stuff like this report because this is real time, real solid information that's actually happening.
Jerry, go down real quick. Let's go to right there. Click on the Arizona, the state to the right there. Down. Oh, there you go. Yeah, there you go. Arrival percentage, 50.3%. So obviously it's ranked 8th in the country right now. So this is how you use this as an interactive website. I highly suggest. Now, it's important that you don't just rely on this because there's a lot of stuff. There's the, is it the BLS? I think is one. The Postal Service is another. The MVD or motor vehicle, that's another. So there's a lot of different things that you can look at, and you'll find that they're very different. But what happens is you'll start to see that a lot of this information is all kind of the same. So because a consumer has lots of choices on who they want to, whether it's Atlas Van Lines, North American Van Lines, whether it's U-Haul, they have choices.
So Robert just made a good point on YouTube. He said Portland rents are going down. I've seen about 100 to 200 drops per month over the past 6 months. Also, there's rent control here, and Oregon approved a 10% increase for 2025. So even with the 10% increase, landlords aren't able to increase the rent. They're having to decrease the rent, and that's what you have when you see population declines.
Yeah, that's right. So Oregon is now rebounding. If they actually they did statewide rent control some time ago. I'm a little cloudy on when, but now they're starting to realize that people can't afford to live there. And so that's what happens. When and there's all kinds of other reasons, obviously, but when you start to see population leaving, just like anything, guys, I use the analogy with concert tickets, right? If you got a concert with half full, the tickets are going to be, you're going to have a fire sale, and they're going to be giving them away, trying to fill the butts in the seats. When it's full, then, of course, that's when you start to see ticket prices go up. Think of the World Series, which we just got done with. Think of any big sporting event like that that's really hard to get a ticket. Same thing with the state, with people being there or not being there, with the amount of housing. So it's the same way. So these population and migration figures are really important for you to pay attention to as you guys are going out and investing your hard-earned money.
So the second thing we want to look at is job growth. So job growth is directly correlated with population growth or decline. Because, that makes sense, right? If there's no jobs, people need to move out. If there are jobs, people move places for jobs. So while weather and community and everything matter, jobs matter the most.
Yeah. Even there will be people that compromise even safety, believe it or not.
Yeah.
Which is a big one, though. And also the work from home thing, that's in flux right now, but that's starting to stabilize as people are starting to go back to work. But these are jobs added, and I think it's important that you take a look at that too. Okay?
Yeah. So right. So what we're looking at now, because it's a little confusing here, is that these are the top number is the population growth,
right?
And then what's in the blue boxes is the job growth or decline. So when you can see is that Tucson created more jobs than people moving there, which means that's very good for the people living there.
That would be a good place to invest, guys.
Yeah, that's
right. That means that there's more jobs, less people. So that's what you want to look for, is that inverse relationship. That's exactly what you want to look for.
And so I was looking at Seattle, right? So Seattle has created less jobs than the amount of people moving there. So, but
that should see negative wage growth.
That's going to see negative wage growth and potentially flattening of rents there.
Right.
And same thing in Phoenix.
What's interesting is if you pair up Vegas and Phoenix, you start to take a look at Phoenix has done a much better job than Vegas. On actually attracting jobs, because don't forget, guys, there's a whole division in the government that's actually trying to find employers to relocate, and they're doing all kinds of things to do that, because because people move for jobs. They relocate from wherever they are, obviously for work. And so this is a big one, and that's why we're obviously super bullish on Phoenix and Vegas on the long term.
So I wanted to look at Portland. I couldn't find any job information for. Interestingly enough, it was very hidden. I looked for a long time.
There probably isn't any.
Right.
It's negative.
It's definitely. I would almost guarantee it's negative. But I thought New York City was interesting. So they've lost 600,000 people, but they've also lost 971,000 jobs. So they've lost significantly more jobs than they've lost people, which tells me that they're going to lose more people because people don't have jobs.
Right. And now you can start to see there's some changes being done there in New York. The one thing that I'm just going to sprinkle in real quick the day before election is that New York, one of the reasons that you're starting to see rent growth in New York, immigration.
Well, we're going to get to that.
Okay.
We haven't got to that yet.
All right.
Ken always jumping ahead on the timeline.
What can I say?
Jerry, can you play our YouTube video, please? It's just talking about job growth in the Phoenix market.
Phoenix has some much exciting news for job seekers as it continues to attract new businesses. Many already know about Taiwan Semiconductor in North Phoenix. LG Energy is opening a $6 billion battery manufacturing campus in Queen Creek. Virgin Galactic, Benchmark Electronics, Corning, Meta, Google, all opening up in Mesa, especially Southeast Mesa. Core Power is a renewable energy company which will be opening in Buckeye. In fiscal year 2023, 37 companies announced or expanded in the area, adding 7,700 new jobs with an overall average salary of $72,000. Of those new jobs, more than 5,000 were considered high wage. The average high wage salary for the new jobs was nearly $85,000. Phoenix was actually ranked number 1 out of the 15 top growth markets for largest projected job gains by global real estate firm Newmark Group. In fact, nearly 15,500 jobs have been promised as part of the major manufacturing developments.
So I think what's important to note in that video is not just the fact that we are adding jobs, but we're adding jobs that are well-paying to high-paying jobs.
That's a really good point. Yeah, there's service, worker jobs, let's say, that, a lot of people do that are not as high paying, right? Mm-hmm. And then, of course, you want to look at the quality of jobs.
Right. And so it depends on your rental unit too. If you have a C-level rental, it might not be important what level those jobs are at, right? Because you're going to be catering to the servers and to people like that. But if you have a more A or B level apartment building, B plus, A minus, you're going to want to make sure the jobs that are being created are in that demographic where they can afford your apartment.
Yeah. And don't forget, I grew up in Seattle, as you guys know. I'm there all the time. And one of the big employers that we all know that's actually going the opposite direction is Amazon. Mm-hmm. So, Amazon has been cutting over the years. And so why is that important? It's important because we're talking about investment. So if you own real estate and you're trying to find renters, and some of the bigger employers, and of course, they don't, this is not the tail that wagged the dog here, but it's notable to understand that that this can happen. And so when you start to look at what's going on with jobs, why would an employer move to an area? Well, because their employees have a fair rent. Their employees have a fair house price. Their employees have a fair cost of living. So if an employer is going to move somewhere, they're considering all of these things. And that's where these economic development departments kick in with these cities, is they're trying to attract. So it's really hard right now to attract businesses to New York City because of all the stuff that's going on there. And it's clearly very expensive. And so that $85,000 that you just saw in that video, if that employer was moving to New York, it would have to be well over $100,000 just to live there. And so that's a direct cost to the employer. So that's why all this is really important.
And I think too, you also have to look at where people want to live, because employers are starting to look at that as well. So I know Cleveland Clinic in Cleveland, they employ over 70% of Cleveland Clinic.
Yeah, I hope they stay.
Well, and they had talked a few years ago about leaving and moving down south. I forget what state, but down south somewhere. And I think what really saved them is COVID happened, because they were talking about this in 2019, and then COVID hit, and I think everything kind of went crazy, and they ended up not doing it, at least so far. But that's a major blow. But the reason they were doing it is they were having a hard time finding surgeons and doctors and high level medical professionals that wanted to move to Cleveland to work there.
Well, now they can, and they have.
Yeah.
And for some reason they stayed, which is good.
Yeah.
Can you imagine? Cleveland's been through the ringer, man.
It's been through the ringer. But that's a good point, right? Because we're talking about how great of a market Columbus is, right? And Cleveland is a decent market right now too, but Cleveland is much less diverse in their jobs, right? They don't have as many large companies in Cleveland as you do in Columbus. So that makes Cleveland a riskier investment just by default, because if the Cleveland Clinic would pull out of Cleveland, that would devastate landlords, that would devastate the population, because all those jobs would move with it.
And just think of Detroit, guys. Let's think of Detroit. Detroit at one time was the 5th largest city in the country. Think about that. Now, probably not in your lifetime, but just go back and look. The 5th largest city in the country was Detroit. Now, that was where a lot of car manufacturing happened. So as these big guys move around, and as the economy goes up and down, and as we outsource jobs, and as we, as the new comes in and the old goes out, these are really important things to look at as you guys are investing.
Yeah, and MC, we used to invest in like Oklahoma, the Oklahoma market, right? And we stopped doing that, not because it was a bad market for us, but it was just dependent on one or two industries. And that made us nervous.
Correct. It was oil and gas at one time, real large. I was in Tulsa. I was in Oklahoma City. And by the way, incredible places, but very flat, right? So I invested in Tulsa and Oklahoma City. And I also invested in Phoenix and Tucson, let's say. All right. Phoenix and Tucson went like this, and Tulsa and Oklahoma City just stayed flat. And why was that? It's because where are people going? That's it. So there's not a lot of new construction in Oklahoma, as an example, but there's all kinds of stuff going on in Tucson and Phoenix. And this has a lot to do with job growth. It has a lot to do with what the state's doing to try to attract employers. It has a lot to do with where people want to be for all kinds of reasons. And all of that drives real estate. All of that makes housing prices go up and down, and it also makes rents go up and down.
Yeah, and that's why we make a big deal on the diversity of businesses. That's why we showed that video, to show all the different companies that are coming to Phoenix. And there's a bunch coming to Tucson, and there's a bunch coming to Vegas. And that's important because that is going to drive job growth. And it's so diverse that if just one of them pulls out, it's not a big deal.
Right. So that's why this stuff is so important. And the other thing is that you need to understand it's evolving. It's continually moving. So what we talk about today could be very different in a year, depending on what happens. We have an election tomorrow, so we'll have to see. Who knows what's going to happen, obviously, from there. So those kinds of things can change things.
Yeah, absolutely. And Jerry, we're going to skip ahead. I want you to pull up the vacancy rates. So we're just skipping one and moving to the next one. Yeah, that's okay. Nope.
Let's go back to the other one. Let's talk about this.
Oh, okay. Perfect. That's okay. So we're looking at these vacancy rates here. And then in the blue, I believe is
percentage of homes rented.
Okay.
And I think this is an important thing. And what's really important to see is, now, what do I see when I look at this chart? I think that's important. 56% of the homes rented in the Seattle area, okay? What does that mean? That means that things there are really unaffordable. That means that people can't afford a home. That's what that means. That means that the high percentage of people in Seattle have to rent, okay? That Seattle is, by definition, very much a renter's market, okay? And you can see that, obviously, in New York and in Portland. And Las Vegas is surprisingly high. I used to own in Vegas. I used to live in Vegas. I used to manage property in Vegas. And, of course, we own property in Vegas. One of the reasons that we like Vegas, because, again, if you're looking at this from a landlord's perspective, you want that number high. Now, it's harder to buy because the prices, but as you start to see this percentage go up in Vegas, as an example, the only thing that's going to drive that down is affordability of single-family homes. That's what that does. And so Phoenix has a really nice balance of affordable single-family homes, because the what's supposed to happen is my kids. I have two kids that are in their 20s. They're supposed to build their credit when they're young and grow their savings and then buy a home. And in the Phoenix area, they could still do that. Now, maybe not in Scottsdale, but they can certainly buy a home in some of the other surrounding markets. That is not the case in many, many, many areas. So in some of these areas like Seattle, Portland, or New York, clearly. When you go to New York right now, you don't think, I wonder if I can buy a place. Like, that's not even on the table. The only thing you're thinking about is, how cheap can I get my rent? That's been that way for a long, long time. And so there's consequences with that as well.
And when you're looking at these vacancy numbers, like you have, like Tucson seems to be the highest with 10%, Columbus the lowest we'll talk about New York, but Columbus legitimately the lowest with 5.8%. What are you like? Does that matter as much right now?
Yeah,
or?
of course,
Okay.
of course. Yeah, like when you have this kind of vacancy in rental homes, I think that it's obviously going to spill over, and vacancy is problematic for anyone who owns anything there and is trying to rent it. Right? It doesn't really matter. Now, of course, there's all kinds of nuances and things that you can mitigate there, because for example, if I was going to buy in Portland, for example, I would go look for anything. I would look for 300, 400, 500 square foot apartments actually that are affordable, because you're probably you want to keep them under $1,000 a month as an example, because that would scream like a deal and people would be willing to give up 200, 300, 400 square feet. Whereas in Phoenix, no one's going to rent a 300 or 400 square foot apartment. You know what I mean? And there's no reason to, because you can get things pretty affordably in a lot of the surrounding areas. Now, of course, there's areas that are expensive, and there's areas that are not. But that's what I start to look at. There's what do you look at behind the numbers here? But it's important. One of the reasons why Columbus keeps jumping off the page, and the reason we have it on here, because traditionally it's been a slow market. It's a small market, and we have friends. I'm actually invested with some friends that are in our mastermind in the Columbus market. And it's a great market right now. I personally invested there, and so you're looking at a 5.8% with a high percentage of homes being rented, and all of a sudden you start to see some affordability problems there, and you're still able to cash flow there, where a lot of these other markets you're not.
Yeah, and let's address New York City. So we had 900,000 jobs removed, 600,000 people left, but yet we have a vacancy rate of 1.4%, which looks just totally amazing.
Why. Yeah, I wonder why. Yeah, it's crazy, guys. Just take a look at the immigration numbers in those markets.
Well, and to be fair, because we did say there's a negative 600,000 people that left, even with the immigration. However, I do think it's important to note that the government is renting apartments to house people, and I believe that's what's keeping the vacancy rate so low.
Well, we should talk about the government and their impact, and we might be able to do a whole show on this, actually. The number one employer who's adding the most jobs by a long shot is the government. Mm-hmm. That's jobs, okay? The government is busting at the seams right now of government workers being added. Now, of course, they're funding, these sanctuary cities and these I can't remember what they call them, the immigration registrations and stuff like that, where people are going and they're actually taking down hotels and master leasing them, it's off the charts, guys. And by the way, it's not just New York; it's other places. We're seeing this in California as well. And other places, and we won't talk about Springfield, Ohio, but the reality is there's a lot of people that came across the border, whether it was legally or illegally, and they're putting pressure on housing. Period. That's it. And so what does that do? It takes that housing stock out from other people. And so what should have happened with New York is all those jobs left, all that population left, and all of a sudden home prices should have dropped. Rent prices should have dropped. That's what should have happened. But that's not what happened, because they replaced it with immigration.
Yeah.
That's absolutely exactly what happened. So, and this is, obviously the big part of the debate.
So the next thing is interesting. So I'm going to just say with these numbers that, it's hard to find the exact data on these numbers, so these are estimates, okay? So the fifth thing we're going to look at here is how much supply was added to each market in the last 4 years.
Yeah.
So, you have, and then up at the top is the number of people that moved to
so
the
white,
area.
the white are the units that were added, and the reason I know that is obviously, you guys know we're active in Tucson, we're active in Phoenix, and we're active in Las Vegas. I know for a fact that one of the reasons on the chart before you saw there was a 10% vacancy rate in Tucson is because there were 7,000 units added with 8,000 people.
Right.
Okay, that's why you have a 10% vacancy rate. Now that will get absorbed,
Mm-hmm.
and as you also saw, really, really, really robust jobs. So same thing with Phoenix. You got 55,000, whereas in Las Vegas you got 8,600. So what you're going to see there, if you just look at those two things, is you're going to see pretty robust rent growth in Las Vegas.
And I want to point that out because we just did a deal in Las Vegas that we raised money for called Alta, and that's already closed. But look at the Phoenix 55,000
Right.
versus 8,000, and they had the same number of people move there.
So if you
okay?
just look at that number,
Just
guys,
that.
okay, you got 200,000 people moving in both those cities, and Phoenix is much bigger. And you got 55,000 units being built in Phoenix and 8,600 in Vegas. Which one do you think will have higher rent growth? And of course, we're talking about rent growth here. We're talking about being a landlord. We're talking about where we're going to invest. So now we're actually showing you under the hood as to why we decide as a company, as MC Companies, to invest in Las Vegas. This is why.
Yeah, and also Tucson, right? Like,
Of course. Yep.
Because while they did, while right now there's high vacancy, we know that some of those 200,000 people that move to Phoenix are going to migrate to Tucson.
Correct.
That's just how it works.
Right. So now let's look at timing of all this.
Well, okay.
What I mean by that is, so Phoenix right now is starting to experience concessions. They're starting to experience flat rent growth. They're starting to experience a fight for every renter because you have 55,000 units being added. That's clear. All right. And so that's a great time to buy. That's a great time. You want flat as somebody who's trying to buy property. So that's why we're super active on trying to buy in Phoenix right now, is when you start to look at a large amount of supply, even if it might be for a short period of time, it's going to disrupt the the operations, because when you add that many units and you have a limited amount of people coming in, it's going to be better for the renter. So said another way, Las Vegas is not necessarily great for the renter, but in Phoenix it's great for the renter, all things being equal.
And I want to look at Portland and New York City too. And in New York City, the data was a little skewed too. Some said 11,000, some said 23,000 units added. But so in Portland they added 7,000 units, which is not very much for such a bigger city, right? But they lost 23,000 people. And then in New York, they either built 11,000 or let's say 23,000 units, and they lost 600,000 people. So that's obviously not good, right?
No,
like
that's not good at all.
That's not good. But I did want to point out Seattle, because Seattle's kind of that middle market, right? Like Columbus and Tucson and Phoenix and Vegas are all doing pretty good. Portland and New York City are doing pretty bad, but Seattle's kind of, their population grew, whatever. But if you look, they added 37,000 apartments and only 18,500 people moved there. So that's why you're seeing. That's a pretty big flag, because the population's not growing significantly for such a big city.
Yep.
Jobs are leaving, and there's a bunch of supply that was just added that's unneeded. And I don't live in Seattle and I don't watch that market, but my guess is there's a lot of concessions there right now.
Yes, it's important, guys, that you understand there's a lag. And I always talk about lag. So what does lag mean? That means when the Fed, let's say, increases interest rates, there's a lag. It takes a while for it to make its way through the economy and for it to tighten up. Same thing the other way. Same thing with units. There's a lag. So as these units get delivered all over the area, Seattle's big, then you'll start to see lots of options from a renter standpoint, and the developers of those units, they're going to have to offer concessions to try to get people to move in. They're not going to have rent growth. So Seattle's toast for a while because you have not a lot of people moving there. This is a very large city, guys. Seattle is, I don't know off the top of my head how it compares to Phoenix, But I having grown up there, I know there's a lot. It's a big town. So 18,000 versus 200,000 to Phoenix. That's what you need to look at, and take a look at the units. It's not that far off if you look at the percentages. Seattle's going to be in trouble for the next few years. So is that bad? Maybe. But it's a market to watch. It's a market to watch. So you would want to start looking at Seattle in 25, 26, 27 when, there's a bloodbath going on there. Unless, of course, there's an influx of people to absorb those units. But what you always want to do when you're buying is you want to look for units that are destroying the operations for a market. The property management is really hard. It's super competitive. You're trying to get tenants. The vacancies are high. You're offering all kinds of stuff to get people to move into your place. That is the time you want to buy. That's where Seattle's headed right now.
Yeah, absolutely. And I want to touch on, so when we're looking at, because this is really the most important chart, right? Because when you're looking at is how the population is impacting versus the supply. And we always talk about immigration and how that's pushing rents up. And sometimes I think people think we're being political or we're being whatever, but we're not. These are just factual data. If you have more people, no matter whether they come from Mexico or they come from Texas, it doesn't matter. Based on your supply, it's going to either push rents up or down. They're either going to, there's either going to be job creation or there's not. So these are just real life facts. And that's why it's even important to understand for the people immigrating, where are they immigrating to? Because that is a place where the rents are going to be pushed up.
Yeah. Guys, it's just math. Don't make it political.
Yeah, it's not. But I did want to say that if you are interested in investing with MC companies, you just need to go to investwithmc.com/YouTube. We do only take accredited investors at this time. If you're unsure if you're accredited, you can always email info@kenmcelroy.com. All right, so let's hop into our questions for the week. We have some very astute YouTube people on here today. I'm very impressed.
Let's go.
So, YouTubers, if you have questions, let me know. So, Darren is first. They said, I've inherited a few duplexes and a 10-unit complex, and the rest are divided among family members. The property hasn't been managed properly, and I'm determined to start fresh and keep things compliant, but I don't want to hire a property manager. Can you recommend resources or guidance for managing it effectively?
Ooh. First of all, number one, congratulations. I'm glad you got that. There's obviously, I'm biased here, but one of the books that I wrote was the ABCs of property management. And then what I would do is I would get involved with there's a bunch of local property management trade groups, like for me, the Arizona Multi-Housing Association, and there's small owner groups, and there are typically very, very, very good resources in that particular area. What you want to do is you want to get really in tune with is it what did you say, Washington?
I don't think
you want to get really in tune with the landlord-tenant laws in that market. The one thing about that 10-unit project, and it sounds like you have a few, so I'm guessing that means 6 units, a few duplexes. You are a little hindered with what's going on the other 4, because if one's in somebody's own a different one, and the rents are $1,500, that's going to be you're going to have that as kind of a competition. So, but I always tell people, if you have the time to do this, do this. I actually do agree you should. 6 units, you've got about that. I mean, you can rent 6 units, especially in one location.
Yeah, you can
send
manage
one handyman there.
Yeah. Gosh, I wish mine were all in the same spot.
I know. So there's a lot of advantages to having them in one spot, because Danille's got them all over the town, and so she sends a handyman, and they're driving all over the place. And they're probably similar, which is also good. So there's a lot of positive benefits, but it always has to do with time. Where do you want to spend your time? But if you don't know anything about it, I highly encourage you do it. But you can also go out and solicit other property managers and find out what resources they're using. But most of the stuff is available online. You should Google it pretty easily and pretty quickly now, I've seen.
Yeah, and just know, you're going to learn as you go, and that's just part of the process. So Sabiku is asking, when you refinance, does it change the lower interest rate of the loan? So I'm assuming they have a low interest rate in considering refinancing.
Yeah, so that's actually, it depends. Obviously, we have a lot of loans right now that are below market. What's market? Let's say in the fives and mid to high fives. Now, I'm talking about commercial Fannie agency, Fannie or Freddie agency stuff. Our rates are today are in that range, and I know that because we just bought that property in Vegas, and I think we locked at 5.7. I think it was. So now we also have stuff that we own that's in the threes, as an example. So when you have a property that's in the threes, a refinance means that you're actually leaving a very good loan, and it's going to cost you almost 2 percentage points higher or more. And so it can also go the other way. So if you have something that, say, is in the sevens and you're able to get it in the fives, then yes. And so you always have to take a look at whether that's worth it. So right now, I always tell people that if they've got stuff in the fours and threes, they're probably better off not refinancing, even though a lot of people want that equity. The other thing I would just mention is you probably should have a place for that equity. So don't just refinance to refinance, right? You want to have a purpose for that money, and hopefully it's being reinvested somewhere, and not just remodeling your kitchen, or whatever that might be. So you want to make sure that if you're going to, more than likely, if you're talking refinance, you probably are actually looking at a higher interest rate loan based on the history we've had over the last few years.
Yeah, and if you do want it for something like pull a little bit of money out to maybe help with something like a kitchen remodel, look at doing a home equity line. Even though those typically are variable, you could keep your low rate you have and just take out a little bit of money for that on a higher rate.
And then I'll just point out one last thing that's a significant advantage to a refinance, and that is that money you get is tax-free or tax-deferred. So what that means is when you're getting a new loan to replace an old loan, and there's proceeds from that cash out refinance, that's actually not taxable because it's debt. So you don't pay tax on debt. You pay tax when you sell something. So that's why that's the Burr model, right? That's the buy, rehab, refinance and repeat, I think it is. So that's what that means. And now that works if rates are stable, and it also works if rates are going down. But when you're actually refinancing out of something lower into higher, it might be the opposite. So don't forget to look at that new mortgage payment.
So our next question comes from Karen, and this is a question we get quite often. If I'm only making $200 a month on a rental without calculating CapEx, how will I ever be able to retire on this? I'm 34.
Yeah, I'm sorry. You won't. I mean, no. Listen.
Okay.
No. She's talking about retire. Okay. I mean, I know that's kind of brutal, but it's the truth. It's a heck of a question. That's why she brought it up. So you got to tell her the truth. And here's the reality is, your tenant is paying down your mortgage. Okay, that's good. Hopefully, it's not interest only. If it is interest only, but on the other side of that, well, you're not going to retire on $200 a month of cash flow. That is actually what I think her point is. So now there's a couple things. It doesn't mean you sell it. If you have an opportunity to refinance and get that interest rate lower, then of course that helps your cash flow, and maybe you can scoop out a little equity, maybe not. But what you need to do is you need to cobble these together. You need to have several of these. And I know Danielle's looking at me. I know that she's got something she's going to say. Because they're completely...
I have some more words of encouragement, Karen, than Ken does. So,
what is it?
Well, what I was going to say is she's 34. So I'm assuming she has a 30-year mortgage, maybe 15, but probably 30. So by the time this thing's paid off, if you don't refinance and you let this loan ride out, rents are going to increase, over the next 30 years. And
so will expenses.
And so do expenses. But, it'll start to cash flow a little more. But then once the mortgage is paid off, to Ken's point, probably can't retire on one rental. However, if you're making, $1,500 on this rental after your mortgage is paid off, that will be significantly helpful when you do retire, along with Social Security, or if you can snag up a couple more of these. But I do think with people, they get frustrated, because she even said 200 before CapEx, so she's really probably at about break even. But over time it will be better. And also when the home appreciates, if you want to, we don't recommend this, but you can sell it and scoop out that money as well. So it's not...
Here's what I believe. I believe rents are going to go up based on supply, and I believe that house prices are going to go up as well. So what you have is a coupon where your renter's paying it off for you, and I'm sure it's frustrating. You don't have a lot of cash flow, but the reason why I said what I said is because you were actually talking about retiring. That's why. Is it worth keeping? Yes. It definitely is. It's covered, right? And where else are you going to move it? And so that you might have an option there.
Well, and I do want to touch on this too, because I've even done this with my own rentals, and I wouldn't necessarily say it was a mistake, but it does stress things more. So you bought something that's very low on cash flow and argumentably breaking even at best, right? Because you're probably not calculating vacancy and you're not calculating CapEx, and you're only making $200 a month. So that, for those looking to invest, like when you're that tight, it does make it more stressful, because what Karen's probably not saying is that she's having to come out of pocket here and there, even though it's making $200 a month, because, an AC unit goes out, or, something like that happens.
Or a tenant moves.
And it's sitting for a month and a half, 2 months on the market. So that's all negative cash flow. So, to be fair, the reason I feel like, Karen, that you're upset and you're stressed is because you're probably losing money on this unit if you really look at it. So it feels more like a burden, and you're wondering how long you're going to be carrying that, right? So just those listening, that's why we always preach to have cash flow and to calculate in things like CapEx and vacancy, which a lot of people don't, unless you can just totally afford to come out of pocket, and some people can as well. But I do understand why for her it probably does feel like a burden.
It's fair. If you have a significant amount of equity, and this is another way to look at it. I'm actually looking at this on some of the properties that we own. I have a lot of money in equity in a lot of deals. And so you have to take a look at the cash flow on that equity. So if you have a plan for that equity, and you also have to calculate tax. So if you exit this and you have a capital gain, you have to calculate that in, because that's the net number. That's the number that you will be getting, and because you're going to have to pay tax. And then if you can replace that somewhere. So, for example, right now I'm in the process of putting a billboard deal together with two young guys that I really like. And it kicks off about a 12 to 14% cash on cash. Okay. So we've got the lease, we're putting a billboard up, and based on the revenue at like 70% occupancy, it kicks off about a 12% cash on cash. So you have to calculate what your real cash on cash is. So is it $200 a month or $2,400 a year, or is it really $1,000, or is it a break even? And then what's your equity in there? And then can you move that equity to something else that actually makes more money and per month? Because it's a heck of a question. And this is, we get this question a fair amount, and I don't want to tell you to sell it. Obviously I'm a huge I really believe people should have real estate and own it for the long haul, especially if a tenant's paying it off for you. But you always got to be looking at that. What's your actual real return on the money you have in there?
And M. Deering said, my Sierra Vista property manager just sent me an HVAC replacement invoice. CapEx is real.
Yeah. I mean, HVAC, gosh, they're in the thousands now. What, $5,000, $6,000, $7,000 to put an AC unit in, if you can believe that. It's insane. But a lot of it has to do also with, is it under rented? It could be. Is it in an area there's lots of rentals? Okay, that would be something I would consider. If it's in an area there's not very many rentals, then you're probably going to be pretty good long term. Like Danille has a place that she bought. It's a condo unit, 300 units. It used to be an apartment building, but it's a condo, and she's kind of she can't raise rents more than her neighbors. So. Or is it in an area that there's not very many, and so you have to look at kind of the next 1 to 2 to 3 years, but I do see positive rent growth in most markets over the next few years.
Awesome. Well, thank you guys for tuning in, and we will see you next Monday.